Welcome to Talk Tickers, your deep dive into synthesizing the latest earnings intelligence. Today we are focusing on Agilysys, that's AGYS, following their fiscal 2026 second quarter results and what was a very closely watched conference call. And the story coming out of this call, well, it's not just good news. It feels like real confirmation that their big multi-year shift, towards cloud-native solutions, it's really hit its stride. Escape velocity, maybe? The stock reaction certainly seemed to agree with management's very bullish tone.
Exactly. And look, we're not just going to read out numbers here. Our mission today is to really get under the hood for you, unpack what's driving this performance. We're going to zero in on, I think, three key things. First, that crucial shift in the revenue mix towards subscription, high margin subscriptions. Yeah. Second, how they're building what looks like a serious competitive moat in hospitality tech. And third, and this is vital for investors, the sort of hidden potential, the optionality that came out in the guidance increase discussion.
Okay, before we dive into the strategy stuff, those headline numbers, they're just too strong to gloss over. Walk me through the top and bottom line beats that really kicked things off.
Yeah, it was pretty much a clean sweep against expectations. Revenue landed nicely at $79.3 million. That sailed past the consensus estimate of $76.9 million. And, for anyone keeping track, this is actually their 15th quarter in a row of record revenue. That kind of consistency, quarter after quarter, that's what momentum looks like.
And you can see the efficiency improvements too, right? Adjusted EPS came in at $0.40. That's a couple of cents better than the $0.38 consensus. But it wasn't just about beating estimates, was it? It felt like it validated the demand they're seeing right now, mid-year.
That's precisely it. It shows that pipeline they've been talking about. It's converting and converting fast. But the metric that really tells the re-rating story, the one everyone's focused on, is subscription revenue. That jumped 33% year over year. That's the engine. That's what's driving this whole valuation expansion story.
Okay, let's really unpack this structural shift then, because this seems like the bedrock of the whole bull case. The recurring revenue, the sticky stuff hit a new high, $51 million. That's now, 64.3% of their total revenue? That's a huge asset. But how sustainable is that kind of growth?
Well, sustainability was exactly what management kept emphasizing. This isn't some one-off blip. It was the seventh quarter straight where subscription growth topped 30%. They're nailing this transition. And crucially, the subscription backlog, still at record highs. It's up 30% just since the end of fiscal 25. So you put that consistency together with a massive backlog, well, that gives you incredible visibility into future cash flows. That's what the market loves to see.
And if you drill down into the specific products, it gets even more interesting. They pointed out that organic subscription revenue, just from their core property management systems, the PMS and its add-ons, that grew by a staggering 55% year over year. Organically. That's huge acceleration in their most critical software piece.
And that adoption, it's feeding the backlog everywhere. The total product backlog jumped significantly, end of the quarter 49% higher than the previous one. That kind of depth, it gives them, like I said, really, really good visibility for the rest of the fiscal year. It's a big signal that, maybe the current guidance is still a bit conservative.
Speaking of conservative, let's touch on operational leverage. Adjusted EBITDA hit $16.4 million. That keeps the margin right on track for that 20% annual target they've set. And free cash flow looked incredibly strong, $15.0 million for the quarter. Compare that to just $5.9 million this time last year. But the real power move, for me anyway, was the balance sheet cleanup, paying down $24 million on their credit revolver. And now they're officially debt-free.
Yeah, that flexibility is enormous. It often gets kind of lost in the shuffle with all the growth numbers, but being debt-free gives them maximum optionality going forward.
Okay, but that raises a really interesting strategic point, doesn't it? Being debt-free is great for organic growth, sure, it gives them options, but doesn't having such a clean balance sheet, plus this accelerating subscription revenue, doesn't that also make them look like a really tempting M&A target for a bigger fish wanting to own hospitality tech? Or maybe they're signaling they want to do the acquiring.
It definitely puts both scenarios on the table. Management's clearly building a fortress here, right? High growth, tons of recurring revenue, zero debt. So yes, that gives them the dry powder to potentially make their own strategic buys if the right opportunity comes along. But it also really solidifies their value just staying independent. I think in the near term, it mostly signals confidence. They're saying, look, we don't need outside cash to keep scaling this thing. They're generating enough internally to fund growth and hit that 20% EBITDA margin target. Pretty impressive.
All right, let's shift focus a bit to sales execution. They mentioned their best ever July to September period for sales. And their second best quarter ever for annual contract value, or ACV. So the momentum's clearly there. And it really feels like it's being driven by how deep their product ecosystem goes now.
Yeah, and the way customers are buying totally backs that up. They said new customer sales were 100% subscription. That's exactly the kind of high quality revenue you want. But the really mind-blowing stat was that new customers are signing up for an average of 7 products per deal. That's a new record for them.
7 products. And, okay, if that wasn't enough, customers buying the core PMS, they're going even wider, averaging 14 products per deal. 14, I mean, that screams platform value. But I have to play devil's advocate a little here. Isn't there a risk selling 14 different modules, even integrated ones, to a hotel group? Doesn't that create huge implementation headaches, customer fatigue? Could that become a bottleneck?
That's a fair question, and it's exactly what their big re-engineering effort was meant to tackle. Management really leaned into this on the call. They see this success as proof that creating this unified cloud-native ecosystem works. Because all those products, PMS, booking, loyalty, golf, spa, you name it, they all live on one platform, share one data profile. It massively reduces the implementation pain and the cross-selling friction compared to the old way of stitching together dozens of separate, non-integrated bits of software. That unified approach, that is the competitive moat.
And that integration lets them win everywhere, too. We saw strong results in gaming and casinos. That's impressive because that vertical was already doing well. International is clearly a huge growth area now, up over 35% year over year. EMEA apparently had record performance. And we can't ignore food service management, FSM. Those sales were up more than 2.5 times compared to last year's Q2. Shows the new POS platform is really getting traction.
Right. And then finally, we have to talk about AI for a sec. Management confirmed it's having an increasingly positive effect. Automating complex setups, making product development faster, enabling new features like smart guest profiles. But here's the really clever part, I think, for investors. Their licensing model. It's based on endpoints, so the number of hotel rooms or POS terminals. It's not based on the number of users.
So basically, they get the benefit of AI making things more efficient, but they don't have to give back pricing if the customer needs fewer staff. Like, if a hotel uses AI to automate half its back office and cuts user logins, Agilysys' revenue isn't hit. That's brilliant licensing strategy. It absolutely is. Their revenue stream is essentially shielded from the very efficiency gains that AI is supposed to bring, which theoretically could erode software pricing over time. It's a really important insulator against those kinds of deflationary pressures. Hashtag investor context and guidance checkpoints.
Okay, so all this momentum, this execution, it leads straight to the guidance raise. And that was clearly the main catalyst for the big stock move, right? The market aggressively rewarding that credibility. So let's lay out the new numbers. Full year revenue now guided to $315 million to $318 million. That's a nice jump from the old $308 to $312 million range. And full year subscription revenue growth gets another bump up to 29% now from 27% previously. The adjusted EBITDA margin target, though, stays firm at around 20%.
Right. But here's where it gets really interesting. And this is probably why the stock reacted so strongly and continues to hold up. That raised guidance. It specifically excludes any material subscription revenue from that big multi-year PMS project they have going, the one that's currently in beta testing. Management is deliberately, consciously choosing not to bake that revenue in until they're absolutely sure about the timing and rollout.
Wow. Okay, so they're basically saying, here's our fantastic new guidance based on everything we know is happening. Oh, and by the way, there's this other potentially huge revenue stream from this major project that we haven't even included yet.
That's right.
That's some serious high-quality optionality baked right in.
Exactly. It's a known unknown, but with potentially very high value. It gives the guidance they did provide immediate, credible upside potential. And furthermore, they tackled the question about delivery capacity head on. Remember concerns about whether they could handle this record backlog? They said the needed improvements in their professional services team, the capacity expansion that was finished earlier this calendar year, like back in April or May. So the implication is their internal delivery capacity isn't the bottleneck anymore. The main constraint now is just normal customer-side delays you get with complex projects. That really shifts the risk profile, doesn't it?
It does. So, okay, what does this mean for valuation? The momentum is undeniable, the beats are clean. But after that huge stock surge, we did see some commentary pop up, flagging valuation as something to watch. If this pace slowed down, maybe the stock looks expensive. But it feels like the acceleration into this guidance raise suggests slowdown isn't the immediate worry. Hashtag, this is not financial advice segment, the trade pitch. All right, now for our favorite segment. Let's imagine you're pitching a high conviction trade idea. You're in front of a very skeptical investment committee. And your pitch has to be based only on the specific details and optionality revealed in this earnings call. What's the trade?
Okay, committee. The trade idea is this. Go long AGYS. But specifically, do it using out-of-the-money, longer-dated call options. Think maybe 6-month expiry, perhaps even a bit longer. We're positioning for a potential catalyst within the next, say, 2 to 3 quarters. The rationale is straightforward. Yes, the market liked the organic growth. Yes, it rewarded the guidance raise they gave us. But the real alpha opportunity, the edge, lies in management's very deliberate choice to exclude the revenue from that big PMS project still in beta. That specific known optionality. That's the catalyst we're betting on.
Okay, so it's a focused bet. High conviction, but definitely focused on that project timeline and its successful rollout. What's the main risk you see there? I mean, is the market maybe underestimating just how complex rolling out a huge multi-year PMS beta can be?
That's precisely the risk. It boils down to implementation velocity and complexity. If that beta phase gets bogged down, if it hits major snags or delays significantly, well, those options could expire worthless. But here's what we're betting on. First, that management wasn't just talking when they said they fixed their internal delivery bottlenecks earlier this year. And second, that whatever customer-side delays exist get resolved faster than the market currently expects, certainly within that 12-month kind of horizon. If that beta finishes successfully, and maybe even a bit ahead of schedule, management has to bring that subscription revenue into their formal guidance. That could realistically push the fiscal 26 revenue number up past, say, $330 million. And since that would be high-margin, sticky subscription revenue coming online, it could absolutely trigger another significant re-rating for the stock. It's fundamentally a bet on execution speed. Hashtag tag outro bet.
Okay, let's quickly wrap up the key takeaways for you from this Agilysys call. Record revenues, obviously. Phenomenal 33% subscription growth continuing. Clear validation of their ecosystem dominance. Remember that 14-product average for core customers. And critically, significantly raised guidance, but guidance that has this high visibility and strategically excludes a major potential upside driver that's currently in beta.
And maybe here's a final provocative thought for you to chew on. Management casually mentioned their total addressable market is, and I quote, a couple of orders of magnitude larger than their current size. So given their confidence, their debt-free status, their cloud-native edge, and this competitive moat they're building with a unified platform, how long can they actually keep up this kind of acceleration? And maybe more importantly, at what point does that ecosystem advantage become a truly insurmountable barrier that the legacy guys just can't overcome?
Something to think about. That's all the time we have for this deep dive into the latest earnings intelligence from Agilysys. We hope this gives you a clearer picture. Join us next time for more Talk Tickers.